Welcome to Talk Tickers. We're diving deep into earnings calls, cutting through the jargon to get to what really matters. Today, it's PROG Holdings, ticker PRG. We're looking at their Q3 2025 results that dropped yesterday morning, pre-market.
Yeah, in this call, it was, well, a classic case of mixed signals, wasn't it? You had this really impressive bottom line beat. I mean, just phenomenal execution, tight cost control.
Absolutely. But then the other side of the coin, the top line was a bit soft. And the market, well, it didn't love the cautious guidance. The stock took an immediate hit.
Right. That's the tension. Great profit beat versus worries about growth.
Exactly. So our mission today is to unpack that. We want to show you the strategic moves happening underneath, like the Vive sale, the tightening in leasing, because management seems to be playing a longer game here, maybe sacrificing a bit of short-term growth to de-risk and really strengthen things for 2026.
Yeah, you almost have to see it that way. Not as pulling back, but preparing, setting the stage for when the consumer picture gets a bit clearer, for cleaner growth down the line.
Okay, let's kick off with the numbers themselves, because that profit story, it was definitely strong. Non-GAAP diluted EPS.
Yeah, 90 cents. And the street was looking for, what, around 74 cents? So that's a huge beat, like 22% above consensus.
Huge beat. And revenue actually came in a little ahead, too. $595.1 million, just nudging past the estimates.
Modestly, yeah. But the real story, I think, was the margin. Adjusted EBITDA hit $67 million. That pushed their margin up to 11.3%.
Up from 10.5% last year. Solid improvement.
Definitely. So you look at that 22% EPS beat, margin expansion.
You'd think the market would cheer, yeah.
You would think. But then you see the stock reaction, and it comes back to that top line. Consolidated revenue was actually down 1.8% compared to last year.
Right. And management kept talking about strength and consistency of execution, the usual phrases.
But the market zeroed in on that 1.8% drop, that deceleration.
Yeah, that number grabs the attention. But like you said, there's context needed. And the biggest piece of context is that strategic shift they announced. The big one, the Vive divestiture, selling off that credit card portfolio.
Exactly. They sold the Vive receivables portfolio to Atlanticus. We're talking about roughly $165 million in receivables.
Okay. And they got decent cash for it.
Yeah, about $150 million in cash. Pretty strong price.
So simplification makes sense on paper, focus to business. But losing $165 million in receivables, that's revenue walking out the door when growth is already a concern. Is that kind of tough timing?
It's definitely a trade-off. Calculated, though. I think management saw Vive as maybe less efficient from a capital perspective, adding complexity.
Okay.
So by selling it, classifying it as discontinued ops from Q4, they streamline things, right? They can laser focus on the core lease-to-own progressive leasing and also free up that capital. It feels like a quality over quantity move for profit.
Right. Improving the quality of earnings, not just chasing revenue. And that cash infusion is big for the balance sheet.
Huge. They ended Q3 with almost $300 million in cash before the Vive money hits. Net leverage was already pretty comfortable, like 1.1 times. So they're definitely building a buffer.
Prepared for whatever's coming. Okay, so that's the strategic cleanup. Let's pivot to the operations, specifically the part that probably drove that market caution, progressive leasing.
Yeah, the core LTO business. Their main metric there, gross merchandise volume, GMV, it was down 10% year over year. Came in at about $411 million.
Okay, 10% down. That sounds like consumers are really hitting the brakes on, furniture, appliances, that kind of stuff. What's the real story there?
Well, management was pretty clear, actually. They said that 10% drop wasn't just broad market weakness. It was driven by two specific distinct things.
Okay, like what?
First, you had the hit from the Big Lots bankruptcy. That was already known, kind of a one-off impact.
I thought it was flagged before.
Second, and this is crucial, they intentionally tightened up their lease approvals. They did this way back in Q1. It was proactive.
Ah, okay. So they chose to write fewer leases, but presumably better quality ones.
Exactly. Prioritizing portfolio health over just chasing volume, especially knowing the consumer might be getting squeezed, they wanted to get ahead of potential issues.
Okay, wait. Let's pause on that. They said if you adjust for the Big Lots hit and their own intentional tightening, what did underlying GMV look like?
This is the key takeaway, I think. They stated that adjusted for those two items, underlying GMV would have actually grown. Mid-single digits.
Mid-single digit growth.
Oh, yeah.
Wow. Okay, so that narrative got completely lost in the headline, 10% decline.
Totally buried. The reported number is really a reflection of them managing risk effectively, defensively. And you can see it worked because their portfolio metrics look good.
How so?
Write-offs were 7.4% of leasing revenue. That's right in the middle of their target range, that 6-8% they aim for. So even though they admit delinquencies are a bit higher than, say, a few years ago, their underwriting changes from Q1 are holding up.
So stable where it matters most. And meanwhile, they're making progress online, right? The e-commerce side.
Yeah, big progress there. E-commerce GMV hit 23% of the total for Progressive. That's up sharply from, 16.6% last year.
It's a significant jump. Shows the online shift is working, even if maybe physical stores are tougher.
Right. And that digital momentum is a good lead-in to the other big piece of the story. Four Technologies. Their buy now, pay later platform. This is the growth engine.
Yeah, this segment's been on a tear. Was it the 8th straight quarter of triple-digit growth in both GMV and revenue?
8th consecutive quarter. Just massive momentum. And it's not just growth for growth's sake. Engagement looks strong. Users are making like 5 purchases a quarter on average.
That's sticky. And the model seems to be working too, this subscription.
Yeah, the 4+ subscription model, that's driving over 80% of the GMV now. And their take rate, looking back over the last year, is hovering around a pretty healthy 10%. The economics seems solid.
Okay, but let's address the confusing part for Q4. 4 was profitable through Q3, but they're guiding to a loss, an adjusted EBITDA loss for Q4. Right during the holidays. Why?
Yeah. That definitely needs explaining. It sounds counterintuitive, but it's basically down to accounting rules for credit losses. It's a timing thing.
How so?
Think about it. Q4 is when they originate a ton of new BNPL loans because of holiday shopping, right?
Right, peak season.
So accounting rules require them to book an upfront provision, basically an estimated cost for potential future losses, on all those new loans immediately in Q4.
Ah, okay. But the revenue from those holiday purchases, that doesn't all hit in Q4.
Exactly. A lot of that revenue gets recognized later, mostly in Q1 of the next year.
Yeah.
So you have this mismatch. You book all the expected costs upfront in Q4, but the corresponding revenue lags into Q1. That creates the temporary loss in Q4.
Got it. So it's an accounting dip, not necessarily an operational one, which implies
a big snapback in Q1 2026. Management explicitly said they expect a meaningful rebound. They actually forecasted Four Tech to have its highest profit margin quarter of the whole year in Q1 26 once that Q4 revenue flows through.
Okay, that context is super important for understanding the guidance. So speaking of guidance, let's look at the full year picture. They revised it, excluding Vive now.
Right. Narrower range and definitely leaning conservative. Revenue $2.41 to $2.435 billion. Adjusted EBITDA $258 to $265 million. And non-GAAP EPS $3.35 to $3.45.
And the implied Q4 guidance within that is pretty cautious too, right? What was the EPS range?
For Q4 specifically, yeah, it implies $0.55 to $0.65 non-GAAP EPS. They're clearly bracing for continued soft demand in durables and ongoing pressure on lower-income consumers through the end of the year.
Playing defense makes sense given the macro. Do they say if they've had to tighten credit again recently?
Interestingly, no. They specifically mentioned they haven't needed to implement further material tightening since that big move back in Q1. So it's just they feel the current underwriting stance is appropriate for now, even with the headwinds. They're just watching things closely.
Okay. Managing risk, generating cash seems like the plan. What about using that cash, capital allocation?
Priorities are still the same. Number 1, organic growth. Then strategic M&A if something makes sense. And third, returning capital dividends, which they paid, and buybacks.
But they paused the buybacks in Q3.
Yeah, they paused them pending the Vive sale closing. But they still have a lot of firepower left under the current authorization. About $309 million still available.
Right. So that pile of cash, plus the fact that difficult comps start to roll off soon, plus the BNPL profit surge expected, it does set up an interesting picture for next year.
Very interesting. Which naturally leads us to
our favorite part, the not financial advice segment, where we take the data, look at the timeline, and brainstorm an outrageous, but maybe just maybe plausible trade idea.
Okay, let's connect the dots here. 3 key things converging, mostly around Q1 2026.
Lay them out.
1, that $150 million cash from Vive, that's basically hitting the bank account now, ready to deploy.
Got it. Catalyst 1, dry powder.
2, the tough GMV comparisons for Progressive Leasing, the big lots effect, the Q1 tightening impact, those start to annualize and ease up in Q1 26. So the underlying growth should become more visible.
Okay. Catalyst 2, easier comps, potential for clearer growth signal.
3, As we just discussed, Four Technologies, the BNPL engine, is expected to hit its highest profit margin quarter ever in Q1 26.
Right. Catalyst 3, peak profitability from the growth engine. So you've got cash, clearing headwinds, and a profit surge all lining up.
Exactly. Now, combine that with the fact the stock is likely priced right now based on that conservative Q4 outlook.
The market might be missing the 2026 inflection point,
Mm,
especially since the LTO business turns revenue into earnings pretty quickly because the leases are short duration.
precisely. So the outrageous but plausible idea. What if management takes that $150 million Vive cash, plus maybe some existing cash or free cash flow, and unleashes a highly aggressive, front-loaded share buyback program right now in Q4?
Okay, so buy back stock heavily while it's potentially depressed by the Q4 guidance.
Yes. Use the cash to aggressively shrink the share count before the market fully digests the Q1 2026 results, the easier GMV comps, that big BNPL profit number.
Huh. It's basically a capital structure arbitrage play. You're using the cash from the divestiture to amplify the earnings recovery that's coming just around the corner, turbocharge the 2026 EPS number.
You got it. It juices the EPS growth right when the operational story is set to improve anyway. It bridges the gap between the cautious 25 guide and the potentially much stronger 26 narrative.
It's aggressive, using that immediate cash windfall to capture the future potential before everyone else sees it clearly. Bold.
It feels like the highest impact move they could make with that cash, given their stated priorities and where the stock might be trading.
Okay, that's definitely something to think about. Let's wrap up this deep dive on PROG Holdings then. Key takeaways. Big Q3 earnings beat driven by disciplined execution and cost control, strategic simplification underway with the Vive sale, boosting the balance sheet.
Right. And the core progressive leasing business, while showing a headline GMV decline, seems healthier underneath once you account for the Big Lots impact and their own proactive tightening. Portfolio quality looks solid.
And Four Technologies, the BNPL segment, continues its rapid growth and is poised for a significant profit jump early next year after the Q4 accounting dip.
So the final thought we want to leave you with is this. This LTO portfolio turns over quickly, right? Leases are short. We've got a ton of cash now from Vive. Management is talking defense right now.
But how fast could they flip that switch? How quickly could they pivot from defense back to accelerated growth the moment they see even a hint of reliable improvement in the macro picture, especially with that stronger balance sheet?
The runway for a potentially rapid acceleration seems like it's being paved right now. Something to watch closely.
A fascinating question indeed.
Yeah.
All right, thanks for joining us on Talk Tickers for this deep dive. We'll catch you on the next one.